What happens when financial independence rhetoric meets financial dependence reality? You get the great American banking awakening, the moment when the world's financial superpower realized its financial security required Canadian cooperation that couldn't be taken for granted when political relationships became hostile. I've been analyzing financial systems and monetary policy for decades, and I can tell you that the revelation of American financial dependence on Canadian banking represents one of the most profound challenges to American economic sovereignty since the collapse of Bretton Woods. Not because the dependence was suddenly created, but because it was finally acknowledged by financial policymakers who had built their careers on the assumption that American financial dominance made monetary independence an automatic reality rather than a carefully managed illusion. The public story, as it's been presented in financial media and policy debates, painted a picture of American financial strength and global monetary leadership. The dollar remains the world's reserve currency, American capital markets set global standards, and American financial institutions dominate international finance. The narrative was designed to project strength and autonomy in the most fundamental aspect of economic sovereignty, the ability to manage your monetary system independently. But the reality behind that narrative was far more complex and far more troubling for American financial sovereignty planners. American financial stability had become dependent on Canadian banking cooperation in ways that made the entire system vulnerable to disruptions in cross-border financial relationships. Currency reserves, interbank lending, and financial infrastructure had all become integrated across borders in ways that made American monetary independence largely mythological. The psychological moment when this dependence became undeniable came during a series of financial stress tests where American officials were forced to model what would happen to American financial stability if Canadian banking cooperation became unreliable. When you trace currency flows, interbank relationships, and crisis management capacity back to their sources, the picture that emerges is of a financial system that couldn't function independently during emergencies without Canadian support. Let me walk you through exactly how this dependence developed because the mechanics reveal important truths about how modern financial systems actually function. Financial independence isn't just about controlling your central bank or issuing your own currency. It's about maintaining financial infrastructure that can operate autonomously during crises. American financial infrastructure had been optimized for global integration rather than independence, and that integration had created vulnerabilities that monetary independence rhetoric never acknowledged. The currency reserve sector provides the most striking example of this structural dependence. During financial crises, central banks need access to massive currency reserves to stabilize their systems, and Canadian institutions had become a critical source of dollar liquidity for American markets during stress periods. American financial institutions had become dependent on Canadian currency cooperation not as a matter of convenience, but as a matter of survival during financial emergencies. When diplomatic tensions threatened the reliability of this integrated currency support system, American financial officials discovered that substituting Canadian currency cooperation with alternative sources wasn't just expensive. In many cases, it was impossible without fundamentally restructuring international financial relationships that had taken decades to build. Entire segments of American financial markets literally couldn't function during crises without Canadian currency support, regardless of how much domestic financial capacity existed theoretically. The banking integration sector revealed similar dependencies that contradicted public assumptions about American financial self-sufficiency. Canadian banks had become so integrated into American financial infrastructure that many American financial products and services couldn't operate without Canadian banking capacity. Financial transactions that originated in American markets were processed through Canadian systems and then settled back in American accounts because Canadian infrastructure offered capabilities and stability that American systems required during volatile periods. This integration worked beautifully when it was treated as a partnership between complementary financial systems. It became a strategic vulnerability when political rhetoric began treating financial relationships in terms of competition rather than cooperation. The moment American officials started talking about monetary independence in ways that ignored Canadian dependencies, they highlighted vulnerabilities they had preferred to minimize. Canadian officials understood this dynamic perfectly and positioned themselves accordingly. Instead of threatening to withdraw financial cooperation, which would have been economically damaging for Canada as well as America, they simply began highlighting the importance of stable, cooperative relationships for maintaining financial security. The message was clear without being confrontational. Financial stability requires monetary cooperation, and monetary cooperation requires mutual respect. What made this Canadian approach particularly effective was how it combined practical necessity with subtle leverage. American financial officials couldn't argue with the technical realities of currency dependence and banking integration limitations, and American political leaders couldn't ignore the implications of financial instability for domestic political survival. When financial security becomes a political liability, policy priorities shift rapidly toward accommodation rather than confrontation. The broader implications of this financial dependence extended far beyond banking issues into fundamental questions about American economic sovereignty and strategic autonomy. When your neighbor controls critical components of your financial infrastructure, that neighbor gains leverage over your domestic and international economic policies, whether they choose to exercise that leverage explicitly or not. Financial security is economic security, and economic security depends on relationships that can be disrupted by political miscalculation. This leverage became visible in how American officials began approaching financial policy decisions that could affect Canadian interests. Monetary policy adjustments, banking regulations, and financial sanctions were increasingly evaluated not just for their direct economic merits, but for their potential impact on Canadian cooperation in financial stability matters. When financial security depends on maintaining stable relationships, those relationships become strategic priorities that constrain monetary policy flexibility. The economic implications reached deep into American financial markets that had built their operations around the assumption of monetary independence. Investment banks, hedge funds, and financial institutions that had developed strategies dependent on Canadian financial infrastructure discovered that their operations couldn't function independently of Canadian banking systems. The gap between political messaging about financial strength and financial reality created market uncertainty that affected everything from currency trading to international lending. From Canada's perspective, this recognition of American dependence created opportunities that Canadian financial leaders had never actively pursued but couldn't ignore once they became apparent. When your banking system becomes essential to your neighbor's financial security, you gain influence over your neighbor's behavior, whether you want that influence or not. Canadian monetary policy began reflecting this new understanding of Canada's strategic importance in North American financial systems. Canadian financial investment started focusing on capabilities that complemented rather than competed with American markets, but in ways that made Canadian cooperation more essential rather than less. Currency reserve capacity expanded, banking infrastructure improved, and financial technology development accelerated in areas where American systems had gaps that Canadian systems could fill. What's particularly striking about this transformation is how it revealed the gap between American political culture and American financial reality. Political leaders could talk about monetary independence and financial dominance, but financial professionals had to deal with the practical requirements of maintaining market stability. When rhetoric and reality diverge so dramatically, financial policy becomes disconnected from financial needs. The international implications of American financial dependence on Canada extended far beyond bilateral relationships into global monetary politics. When other countries observed that American financial independence was largely mythological, it affected how they approached their own financial relationships with America. If America couldn't maintain financial independence from its friendliest neighbor, how credible were American monetary partnerships for countries that needed financial stability guarantees? This credibility gap became visible in how international financial partnerships were structured. Countries that had traditionally looked to America for financial technology and monetary stability cooperation began developing alternative arrangements that didn't depend on American capacity to deliver financial independence that America hadn't achieved for itself. When the financial guarantor can't guarantee its own independence, the guarantees become conditional rather than reliable. The technological dimension of American financial dependence on Canada is equally significant but less visible to the general public. Modern finance depends not just on central banks and currency, but on advanced financial technology, secure communication systems, and sophisticated risk management infrastructure. Canada's strength in financial technology, secure banking systems, and risk management innovation made American financial stability dependent on Canadian technological capabilities in ways that monetary independence advocates never honestly addressed. When political relationships affect access to these technological resources, financial independence becomes even more mythological. You can't maintain independent monetary systems with dependent financial infrastructure. And American financial infrastructure was deeply dependent on Canadian technology, expertise, and capacity in ways that financial independence rhetoric never acknowledged. The most sobering aspect of this entire revelation is how it demonstrates that financial independence requires not just domestic monetary capacity, but domestic political wisdom that prioritizes long-term financial stability over short-term political advantage. Financial systems are built over decades and depend on trust that extends beyond electoral cycles. When political culture undermines that trust, it undermines financial security regardless of domestic monetary abundance. For American financial planners, the recognition of financial dependence on Canada forced a fundamental recalibration of what monetary independence actually means in practice. True financial independence would require massive infrastructure investments, technological development, and system restructuring that American financial economics had proven unable to support independently. The alternative was accepting dependence and managing it through stable relationships rather than denying it through monetary mythology. The financial stranglehold reveals more than a monetary policy failure. It reveals the consequences of building political identity around myths rather than realities. When financial independence becomes a political slogan rather than a strategic objective, monetary policy becomes disconnected from the infrastructure requirements that make independence possible. And when that disconnection becomes apparent, the political mythology collapses in ways that reshape financial relationships across an entire continent. As this reality continues to sink in for American financial policymakers, what becomes clear is that North American monetary relationships have fundamentally shifted from American dominance to Canadian leverage. The country that spent decades assuming its financial strength made monetary security automatic has discovered that its financial security has become conditional on maintaining cooperative relationships with its northern neighbor. And once that shift in financial leverage is acknowledged, it can never be completely reversed, regardless of how much political rhetoric tries to wish away the fundamental infrastructure realities that created it.